Thanks for joining us today. I'm Tom Ross, Portfolio Manager on our fixed income team. I'm delighted to be joined by an expert panel today and to really discuss the future of fixed income investing. We're fresh off stage at our London event, so I wanted to share some of the insights and perspectives that we've talked about. I'm delighted to be joined by John Lloyd, Head of Multi-Asset Credit Strategies, and Mia Söderberg, Client Portfolio Manager on our Emerging Market Debt team, and Mike Contopoulos, who is our Head of Multi-Asset Macro Investing. So John, we're going to start with you. Obviously viewing the asset classes from a broad multi-sector perspective, how do you shape how you think about fixed income and what are the key considerations for investors?
Yeah, it's a good question. I think in a tight spread environment like we are right now, you really want to maximize spread per unit of volatility and limit downside. So those are the two things we're really focused on in the fixed income world and really harvesting that yield that we have today.
Okay, so Mia, your team focuses on emerging market hard currency debt. So what are the main attributes and how do you see this developing in the future?
So emerging market debt hard currency is actually a very nice differentiator in any portfolio. And the perception of the asset class has through the last few years been a bit inaccurate because many see it as a very risky asset class, while today half of it is actually investment grade. And the other half is made up by higher yielding names, but many of them are improving, which means that you can find very, very compelling stories compared to developed markets where you very often have more stable or sometimes even deteriorating stories. So there's still potential in this asset class, which is a nice add. Also, you have a carry, which is very interesting. It's about 6.5% to 7%, which gives you a bit of a buffer in this kind of turbulent world that we have nowadays.
And Mike, obviously you consider fixed income within the broader spectrum of asset classes. So how do you see people allocating to fixed income going forward?
It's a great question, Tom. When we think about fixed income, obviously the market has changed a ton. And given our outlook for higher inflation and higher interest rates, I think investors are sort of curious as to how this will affect fixed income going forward in their portfolios and whether or not there's even a place for it necessarily. I think that's why you've seen private credit really take off as an example and sort of alternatives as a replacement for fixed income. We actually think traditional fixed income is still really attractive within a multi-asset portfolio, but it's how you take that exposure that matters. So you're not going to necessarily use diversification, or rather use duration anymore as diversification. Instead, you may need shorter duration assets, floating rate debt, interest rate hedged product to manage fixed income going forward. So it's not whether fixed income holds a place or a smaller place in a portfolio, but rather what's the makeup of that fixed income and how you're using it that I think investors need to consider.
Thank you all. Also from my perspective, I'd echo what's been said, but I'd also add as well, I think within fixed income, whether it be within emerging markets, within other parts of multi-asset credit, there's really some great opportunities for security selection also to deliver returns, really making your portfolios work harder for you in this type of environment. Now, some of the questions we were asked focused on differentiated insights and positioning. What are your highest conviction views for your areas of fixed income in the near future, say for the coming year? And we'll start with you, John.
Yeah, I actually have two. One is a thematic investment across all the asset classes, and that's AI. AI is fueling a lot of the debt supply that we're seeing and creating a lot of opportunities to generate alpha in the fixed income markets. So we have expressed predominantly through securitized and the high yield markets. And then it's also avoiding some other markets like IG where you're seeing a massive amount of supply that's coming in the market where we think spreads will actually widen. And then across asset classes, we prefer securitized right now. You're getting better spread per unit of volatility and spreads are a little wider against history and securitized.
Cool. Yeah.
Yeah, so we like the high yielding part of the universe at the moment. You find very many interesting names. We have Argentina, for example, who is on a nice trajectory with a more stringent fiscal policy nowadays. So that looks interesting. We have an overweight in Argentina. We also like Venezuela. It's interesting since they have so many natural resources. And after they took up Maduro and the support from the US, it actually looks quite compelling. We also like quite stronger credit stories, not as sensitive as maybe Argentina and Venezuela, like Costa Rica. It's one of the most sustainable countries in the world, and they are knocking on the door to investment grade, so that also looks really interesting. Going forward, we think that the geopolitical turbulence that we have from time to time has shown the recent years that EM have become more resilient. And usually when you have a high risk event, like the Iran crisis, the EM market takes a big hit. But recently we've seen that that's not the case. It's rather seen as something that where you can differentiate away from the US and find other places to invest. And since the benchmark is so wide, you have 70 different countries to choose from, you can easily find interesting investment opportunities in that universe. And due to the resilience, it's actually a very nice differentiator now.
Cool. And Mike, for you?
So I think just as much as what you want to own, you also have to think about maybe where you should be underweight at the moment. And given how tight spreads are, and there's a great saying in fixed income markets, Tom, the path to hell is paved with carry. And that's not to say we think there's an imminent blow up about to happen with corporate bond spreads, but certainly spreads are tight. And so we want to be underweight corporate credit here, but take advantage of corporate credit when spreads widen. We actually think there's going to be a great long-term opportunity in corporate credit as the power shifts in a higher rate environment from the borrower to the lender. And so we think actually corporate credit will be attractive at some point, but today, over maybe the next 6 to 9 months, is less so. As an alternative, you want to be in slightly higher spread, floating rate debt, maybe in the securitized market. We think that offers a better opportunity today, just given how tight spreads are in the corporate market.
Great, and maybe, thanks for your comments there, maybe just to add upon to that as well, obviously the importance we all put on risk management, on fundamental research combined with quantitative systematic research as well, but really understanding the themes, understanding the pockets of risk within these different markets in order to provide better outcomes going forward. Great. Sadly, that's all we have time for today. So I'd just like to thank John, Mia, and Mike for their time, and thank you for listening as well.